Is it time to panic? The market certainly is, and that's certainly the question. There's many fears out there. There's Russia-Ukraine tensions that don't seem to be, in some eyes, de-escalating. There's what seems to be a certainty that rates are going to continue to rise and the Fed is going to hike. And we all know what happens when rates rise. It negatively impacts stocks. So what do we do in this highly uncertain environment? Well, we acknowledge it for what it is, a highly uncertain environment. And we take that uncertainty and look within the grand scheme of the many different trends and aspects of this market. We discussed two, rising rates, Russia-Ukraine, and we find where we can find our highest levels of certainty and conviction, and we make decisions around those highest levels of certainty and conviction. For example, some of you may know, and I've put this out on Twitter, that TBT is my largest position. That is a position that benefits from rising rates. That is my largest position. But I also have very high conviction growth stocks that are impacted negatively, historically, from rising rates. I have very high conviction around those growth stocks, but I also have very high conviction around those TBT positions. So I'm playing the TBT position that I have a very bullish case for and feel very good about having. And I also am playing stocks that I have fundamentally a strong case for. And I know there's a lot of scare and fear and panic, particularly in those 10x growth stocks. But let me discuss one of my favorite ones that I like to bring up on this channel from time to time, Editas Medicine. It is now trading below a $1 billion valuation. It is a several $100 million company, and that is well below its pre-pandemic levels. Pre-pandemic, it was in the high 20s, $30 a share. Today, it's at $14 a share. Obviously, you don't want to compare to past prices. The stock got up to 80, got up to 90, peaked at 99.95. We did not have it here. We sold it before it got to those levels, but now we're very bullish around it, and we have at it, and we have a very high level of conviction around this name. And why do we have such a high level of conviction around this name? Well, we look at the valuation at $1 billion, and we look at what it does. It cures all genetic disease. If you can cure all genetic disease, we have a high level of conviction that your valuation is going to be much higher in the future than it is today. And we'll give it 10 years and backtrack that all the way to today. You should get a quite phenomenal return. If in 10 years that company is a $10 billion company and today it is a $1 billion company, it will average right around a 100% return per year. We have to look at it that way. And in an environment where many of these stocks are getting absolutely obliterated, and they have been getting obliterated for a year, you can find certain names that you can have a relatively high conviction around and make purchases of. So Editas, $1 billion valuation, below pre-pandemic levels, but the pandemic has highlighted how important this company is fundamentally. We've seen the research advance during the pandemic, and the company fundamentally improve and do in vivo, so in body edits that it hadn't previously done before. It was only ex vivo before. Yet, I reiterate, the company is below pre-pandemic levels. Just for some perspective, just to highlight that there is an incredibly high level of fear around names like this. Warren Buffett's old professor, Benjamin Graham, wrote a book called The Intelligent Investor. And Warren Buffett says this guy is his go-to guy, taught him a lot of what he knows, and he likes this guy. And Benjamin Graham talks about or highlights and illustrates this notion around Mr. Market. Mr. Market exists at the New York Stock Exchange and is there offering you a price. And your goal as an investor is to make Mr. Market make mistakes. Make him make a bad deal and you make a good deal. Times like this, when stocks like Editas are down tremendously, despite a fundamentally improving case on the merits of the business, I think present opportunities to get in. However, a lot of people own mega cap tech, and we've discussed mega cap tech on this channel, and we've been talking about for some time. Before mega cap tech was at its highs, as it was hitting new highs, we continued to say that mega cap tech should fall, and mega cap tech will pull down the rest of growth stocks. It's fallen down some. Maybe we're closer to a bottom than a top, but we should and possibly could see additional downside in these stocks. Why is that? Rates hit such a low level, and we may see rates continue to go up. But when rates were at a low level, they didn't really offer that much flight to safety. Why would you pick a rate when you could have cash? The return was very little. So what did a lot of pension funds, large investment funds do? They decided to turn to the mega cap tech stocks. These companies have phenomenal products, they are in good markets, and they are fantastic businesses. However, they had an unnecessary premium given to them by bonds. Big funds had to allocate their cash to these companies as a flight to safety. They have obligations to invest money on behalf of firefighters, teachers, etc. And these stocks had a premium built in because rates were so low. So because rates are rising, in addition to cost of capital, competition in the market, etc. Well, I guess it is technically competition in the market. Those mega cap tech companies specifically are going to see some deflation out of them. And we've seen that. Apple is now below its 200-day moving average. There's a lot of moving parts to this market. There's a lot of uncertainties in this market. But in a market of uncertainties, I think the most important thing to focus on is what you are certain about. For me in the past, that has been energy stocks. Energy was trading at a good valuation relative to its earnings. However, the market didn't always treat it that way. That's okay. It's a case, you have to stick with that case as long as you have done the homework and understand the thesis and have a high conviction around it. So, my advice here is find what your highest convictions are. For me, that's that rates are going to rise. Inflation's quite high. Doesn't make sense to own bonds this low with inflation this high. So there will probably be a continued rise in rates. Some may argue that that impacts tech stocks negatively. And it certainly should. And I have argued that it would impact mega cap tech stocks negatively. And it has. And maybe it continues to do so. But then we get to a point of deeper thought where, okay, interest rates are rising. That is a force. That offers me a better return. But do I pick on trading at 3%? Do you mind closing that? Trading at 3% over Editas, which we had previously discussed, if you annualize the potential return that we can expect possibly over the next 10 years to be 100%, are those two assets really competing? Are the same dollars that are considering allocating to a 10-year treasury bond also considering to a high-risk technology stock that could possibly yield 100%? My answer is no. I don't think the people buying 10-year bonds are the same people buying Editas Medicine. I view Editas Medicine's fundamentals as quite strong. And yes, I'm aware that bond yields are rising. I'm so aware of that fact that it's my largest position. But in addition, I can't ignore the fact that Editas Medicine is trading below its pre-pandemic levels. I can't ignore that it just had a massive patent win. I can't ignore that it's down 85% over the last year and 2 months. And I can't ignore that I expect a 100% return annualized over the next 10 years. I fully expect it to be a $10 billion company in 10 years. I don't think that's a stretch. And if you annualize that return, it is a 100% return per year. And I think it's fine to hold that kind of position going into this. Finally, I want to touch on energy because I know many of you watch this channel, have been very aware about my interest in energy stocks and have maybe participated in those alongside me. Energy saw a massive run, a 50% move in just about a week or two off the Russia-Ukraine tensions. That is quite significant. And if you were watching the videos during that period, we liked the move, we believed in the move, but we were realizing gains because we didn't think it was going to hold. Every time there's been a 50% move in energy, or in the price of oil, there has been a recession. That is a statistic that's quite important, but thankfully for that, we have already seen quite a dramatic fall. And we may fall a little bit farther. However, we are now taking that Russia-Ukraine specific short-term geopolitical premium out of the energy oil and the energy stocks. Many of the energy stocks are right back where they were before that hike. If you remember, the stocks underperformed on the way up of that most recent hike relative to WTI and are now, I guess you could say, outperforming the fall in WTI on the way down. With the exception of Occidental, it has outperformed and underperformed in the reverse. So we're now getting back to the supply-demand deficit, the fundamental case. And I'm not saying it's going to end today or tomorrow. This is a bottom. I think we may get a little bit more of an extended decline, short term. China's locking down. You get a possible resolution of Russia-Ukraine. You get China locking down parts of COVID. You have a lot of new people jumping on the wave at the top because they see a massive spike continuing. I have lots of people texting me, hitting me up for that very reason. Energy's going to keep going up. I'm going balls deep. I've seen a lot of that. Those people are not prepared to invest in energy, unfortunately. They might get hit quite substantially right here. And for us that are watching channels like this, that are doing our homework, that are strategic investors, we may enter back into that position and begin to build it back up if it overshoots to the downside. So I want to let you know I'm still bullish energy, but I see a short-term move that might be to the downside. And as you know, throughout last week and a little bit before, I had taken quite substantial portion of my position off. It's still quite a large weight in my portfolio. About 15% of my portfolio is still allocated to energy. And if we see a significant dip here or a dip to more reasonable levels, which is possible, we might add a little bit. Not going to get back to the crazy levels because it's no longer a crazy price. It's a good price, not a crazy price. So we'll see what happens. There are stocks I think are at pretty crazy prices. I discussed Editas Medicine. I've discussed in the past Smile Direct Club. These are companies that I think I like them fundamentally at higher prices. They happen to be very cheap now. I still like them even with rates rising, and I am playing rates rising. So in this environment, you have to decide what your highest convictions are. My highest conviction happens to be rates rising. It is currently my largest single position, slightly underweight total to energy, but still quite substantial. I think there's a good chance that position does well. It has done well thus far. There's a good chance it continues to do well over the longer run. Maybe the Fed gives us a dovish surprise on Wednesday. That is possible. Maybe it cools off. This is a longer term position for me. And I have a very high level of conviction around stocks I had previously sold at a different time, but are now presenting good value for the price. And then there's stuff in the middle, some more value plays that I like. And we are sticking to individual names at good prices, holding them, and having high conviction around them over a reasonable timeline. We are not trying to predict tomorrow. We're not trying to predict the day after. We are trying to invest, make money, and help build good businesses. So that's today's video. And until next time, peace out.